In this lesson, we're going to begin bridging the gap between equity value and enterprise value, and then our valuation, actually looking at comparable companies, comparable transactions, and doing a DCF analysis to value Apple. Now, before we get there, what we have to do is figure out the specific metrics and multiples that we're going to use to assign value to Apple. Now, the problem above is that if we just look at equity value and enterprise value, for example, if you think about it, this is very hard to use to compare Apple's value to different companies because other companies might just be a different size than Apple. So, for example, let's say that we're looking at a company that has a $500 billion market cap. So we might be tempted to look at that and say, well, that company has a 500 billion market cap and Apple is only worth 175 or 176 billion. So therefore the other company is worth more. Well, that's not really the case. They are worth more in that they have a higher equity value, but the relevant metric, what you have to look at is what their equity value and their enterprise value are like in relation to key metrics for profitability of the company. So for example, looking at what they're like in relation to their operating income, in relation to their net income, even in relation to their revenue, for example. Because once you compare these to metrics like operating income, net income, revenue, you can get a sense of which company is actually valued more highly. Because a company that's worth 10 times its revenue, for example, is going to be worth more than a company that's only valued at 2 times its revenue. Clearly, the market and investors are valuing each share, each unit of revenue at a higher basis there. And so that's why we need to get into these metrics, because looking at equity value and enterprise value alone does not give us enough information to do an apples to apples comparison for valuing companies. It's all too easy to just look at it and say, well, this company is worth more because it's bigger, it has more revenue. Just because it has more revenue or has more profit doesn't actually mean that it's valued more highly. You have to look at it on a per unit basis. For each unit of profit, how much is the company worth? For each unit of revenue, how much is the company worth? And so that's what we're going to get into here. Now, in terms of the actual metrics we're going to look at, if you scroll down to the income statement, the bottom of the income statement here, I've created an area with a couple of the metrics that we're going to be looking at in this case. I'm just going to go through and explain each one now. So EBIT, this one stands for earnings before interest and taxes. Now, if you paid close attention to the accounting videos before, you might be thinking that EBIT corresponds to operating income. And most of the time you'd be right, because operating income, if you think about it, is just that. It's earnings before interest and taxes, and also other income and expenses right down here. So most of the time, EBIT is closely linked to operating income. The only difference is that sometimes, depending on the bank and what you're doing, you add back different charges to EBIT. So for example, if you have a one-time charge that does not occur again in future years, you may add it to EBIT. And we'll see in our example here that we're going to do something similar when we calculate EBIT. EBITDA, by contrast, stands for earnings before interest, taxes, depreciation, and amortization. And so in this one, it's very similar, except in addition to looking at it before just interest and taxes, we're also going to be adding back these depreciation and amortization line items right here. Now, the reason why we use these metrics is because we want to get a sense of the company's profitability. And when I say profitability, I really mean a sense of what their cash flow is like. Ultimately, when we're valuing a company like this, we want to get a sense of how much their business operations are actually generating in terms of cash flow. And so that's why we use these metrics. The difference between EBITDA and EBIT is that EBITDA, as you can see, adds back depreciation and amortization, whereas EBIT does not. EBIT is more common to use in industries where depreciation and amortization and capital expenditures are very important. So manufacturing, anything involving the production of lots of physical products that requires many factories and is going to incur huge depreciation expenses, EBIT is more important because you want to take those into account for those types of companies. EBITDA, by contrast, is more commonly used for, say, technology companies, like with Apple right here, or any other type of company where depreciation and amortization are not huge expenses relative to their revenue. They're used more commonly where the companies create intangible products or services rather than physical products with factories. So now that I've explained those two metrics, I'm just going to go in and calculate them so you can see exactly what we're going to do. So for EBIT, we're going to go up to operating income. And in this case, I'm actually also going to add in stock-based compensation because that is a non-cash charge. You can see that it's not listed anywhere in this formula, EBIT or EBITDA, but generally we want to add back charges like that that are non-cash because if you think about it on the cash flow statement, we're also adding back stock-based compensation to reflect the fact that it's not actually taking away from our physical cash. For EBITDA, by contrast, I'm going to take operating income and then add stock-based comp, amortization of intangibles, and then depreciation and amortization. Take those and copy it across with Alt ESF. Now the next one on here, free cash flow. So this one is also fairly simple. Free cash flow is defined as cash flow from operations minus capital expenditures. In this case, we're actually going to be adding CapEx because it has a negative sign right here, but that's the definition. Cash flow from operations minus capital expenditures. Now, free cash flow is similar to EBITDA in that we're adding back depreciation and amortization both times. The difference is that with free cash flow, we're taking into account working capital and capital expenditures. Free cash flow is common for a couple types of companies. Any company where working capital and changes to line items like accounts receivable, inventory, and so on is very large, we're more likely to use free cash flow to take that into account. Any company where capital expenditures is large and very important, we're more likely to use free cash flow to take that into account. Another class of companies where we tend to use free cash flow is any company with subscription revenue. So any company with subscription revenue that has a large deferred revenue balance, we're more likely to use free cash flow. The reason is because oftentimes, if a company has a large amount of subscription revenue over many years, for example, they may not record everything as revenue all at once. They may put out on their balance sheet and call it deferred revenue and defer recognition for a few years. We want to reflect the fact that they're actually earning more in revenue than they're showing on their income statement, so we like to use free cash flow for any scenarios like that. So to enter the formula here, I'm going to go down to the cash flow statement. I'm going to take cash flow from operations, and then I'm actually just going to add capital expenditures because remember the sign here is negative already. We see that in this case, EBIT, EBITDA, and free cash flow for Apple are all very close. They diverge a little bit in future years, and it looks like free cash flow is actually growing at a smaller rate here, but at least in year one, they're fairly close here. So I'm just going to go over here and enter the formula for free cash flow so you remember it. Cash flow from operations minus CapEx. Now also on this free cash flow line item, there are actually multiple ways you could calculate this. You could, for example, remove interest expense and interest income from this, in which case that would be unlevered free cash flow is what you call it. If we include interest income and interest expense, then we call this levered free cash flow. Now remember that in our calculation from the cash flow statement right here, our net income number includes the impact of interest income and interest expense. So in this case, we're dealing with levered free cash flow. Now the final metric here, book value per share. So this one, the definition of book value is a company's tangible assets minus liabilities. So what exactly is a tangible asset? Well, a tangible asset is anything that is not intangible. So basically everything except for goodwill and other intangible assets would be a tangible asset in this case. So the formula for this one, we literally take our total assets, we subtract goodwill, we subtract other intangible assets, and then finally we subtract liabilities. That just gives us the lump sum number here. What we want to do now is actually take this, multiply this whole number by 1,000, and then divide by the diluted shares outstanding. Now, the reason that we do this is because we want to look at book value on a per share basis most of the time. it doesn't really make any sense to look at this as a lump sum value, because later on we're going to be using this in calculations that need to have it on a per share basis. So similar to earnings per share that we have right here, we always want to look at book value on a per share basis. You could list the lump sum as well, but in actual calculations, it pretty much always needs to be on a per share basis, as we have right here. Just copy it over there. If you're wondering what book value actually means, well, the name itself suggests the meaning, because remember that a company's balance sheet, you can also call that the company's books. So basically you're looking at the company's balance sheet and you're saying, okay, if this company sold all of its tangible assets and then used them to repay all of its liabilities, then how much per share would the company actually be worth to shareholders? And that's what book value is telling you. Book value tends to be extremely important for companies like financial institutions or anything else that depends on a large reserve of assets on the asset side of the balance sheet to do business. So anything with a huge amount of assets that is a very balance sheet centric company. So banks are a perfect example because they use their balance sheet to do everything, to make loans, to receive loans, to earn interest payments, for example. So any company where a balance sheet is a huge part of its business, book value is going to tend to be important there. Just fix the border over here. So that's an overview of some of the key metrics that we look at when valuing companies here. Another key metric is earnings per share, which is right here, but we went over that before. That's just net income divided by diluted shares outstanding. In the next video, I'm going to be showing you how to actually use some of these in the valuation. What I want you to do now for your practice exercise in this video is to finish using these formulas and to fill out what Apple's EBIT, EBITDA, levered free cash flow, and book value per share are going to be in future years right over here. So remember that the definitions are listed right over here on the side. So you can refer to these if you get stuck or run into trouble. You can also take a look at the existing formulas that you have right here. But what I want you to do is to actually fill them out for the first year here to make sure that you understand the concepts, and then you can either keep filling them out or just copy them across. It's your choice. What you should do now is pause the video and you should try to fill out what Apple's EBIT, EBITDA, levered free cash flow, and book value per share are in the next 5 years. Once you're done with that, you can unpause the video and then I'll go through it and you can check your work. Okay, good. So let's go through this exercise. I'm going to review and show you exactly how to calculate these numbers. So for EBIT, we just take operating income and we add stock-based compensation. For EBITDA, we take operating income, we add stock-based compensation, amortization of intangibles, and depreciation of PP&E. For levered free cash flow, remember that we go down to the cash flow statement, we take our cash flow from operations, and then we subtract effectively our capital expenditures. We're actually adding it here, but the sign is already negative, so we're subtracting it. And then for book value per share, this one is the trickiest. We're going to take our total assets number, subtract goodwill, subtract other intangible assets, and then subtract total liabilities right here. We're going to multiply this by 1,000 to make sure the units are correct because we're going to be dividing it by the share count. And then we divide it by diluted shares outstanding right here. So with those in place, I'm actually just going to copy this across with Alt-ESF once again. I'm using Alt-ESF because I don't want the formatting to change. I just want to copy the formulas here. And so that's how we fill out these key valuation metrics for Apple. We already have EPS filled out from before. So these 5, EPS, EBIT, EBITDA, levered free cash flow, and book value per share will be some of the ones that we look at when we go in and do a valuation of Apple. So coming up in the next video, we're going to be getting into our next topic, which is how you actually use these metrics to create valuation multiples, to use them in conjunction with equity value and enterprise value to actually see how many times revenue Apple is worth, how many times EBITDA Apple is worth, and we'll be going through and looking at a few examples of how to do that, and then you'll get some practice actually making these calculations on your own.